Hello, and welcome to Idea to IPO. I'm Jason Putnam Gordon. I'm an emerging growth and venture capital attorney with K&L Gates. Today, we're going to talk about how to raise seed funding for your startup, convertible notes and safes. I'm very excited to get started. But before we do, I'd like to give you some information. So, as you can probably tell, today's event is recorded. So good news if you've missed some or all of it, as long as you registered, I will send you a copy of the recording afterwards. Now, another piece of information. Today's event is being broadcast live and it is being recorded and will be shared. So please don't provide any confidential information today because it's a public event and a public forum. All right, now, I'm going to tell you a little bit about my background, but before I do that, I've got just a couple more things to say. First, today's discussion is general information. It's not legal advice. So we'll be talking about rules, we'll be talking about experiences, we'll be talking about exceptions to rules, we'll be talking about one-off cases. So please don't take anything to be specific legal guidance for you or your startup. The reason for that is all the facts are going to be important in order to get proper legal advice. So this is not a substitute for retaining competent legal counsel, whether that's me, someone in my firm, or someone somewhere else. And one other thing, again, please don't share any confidential information. This is a public forum and venue. Now, tell you about myself. Please fill out the survey because right after we talk about me, I want to learn a little bit more about who's in the room so we can tailor today's conversation. Again, this is being recorded. And the other piece of information that I'd like you to have is if you've got a question, that's great. Please use the Q&A function as opposed to the chat panel or chat function. If you want to use the chat function and chat amongst yourselves, that's totally fine. I will not be monitoring the chat function today. I will be monitoring the Q&A. And as we move through today's content, I will probably pause, on various topics to try and take some questions live. And I'll speak for about an hour. That's about the much content as I have. And then we'll answer any other questions you got for about a half an hour. We'll focus on questions of general applicability. So that is, who we think the most number of people in the room, the virtual room, will get benefit from. So today's conversation is going to go through my background. We'll talk about considerations when raising venture capital and more specifically seed financings. We'll talk about some considerations when pitching investors. We'll talk about different financing options and strategies. We'll talk about the key terms and considerations for convertible securities, which include both convertible notes and also safes. And then we'll also talk about and give you an overview of valuation and dilution because that's absolutely critical when planning how to raise this type of financing. And then we'll talk about common pitfalls and we'll get to Q&A questions at the end. So I'm an emerging growth and venture capital attorney. I've been practicing law since 2005. My office is in San Francisco, California, but I work with companies all over the US and all over the world in large measure because if you're a venture-backed startup, at some point, you're gonna have some connection with Silicon Valley, the Bay Area, or California more generally. I love working with entrepreneurs and executives and investors as they deploy their capital into these companies. I find it very exciting. Some of my own background is before I sort of returned to big law, I ran my own corporate boutique for about 5 or 6 years. And so I consider myself a bit of an entrepreneur and I'm able to draw from that experience and working with my clients. I find it really resonates well with them. A little bit about K&L Gates. So K&L Gates is a global, fully integrated law firm. That means, we're on 5 continents. We've got over 40 offices, 1,900 attorneys, basically fully full service. And I love being on this platform because my clients have legal needs all through the world, and they also require highly skilled professionals. And I can find all of that here to serve them. All right, so let's find out who's here. I'm going to take 20 more seconds to let you finish and finalize the survey, and I'm going to take a little sip of water in the meantime. Again, if you have a question, please use the Q&A function. That's how I'll take questions. I'm not monitoring the chat. All right, so let's see who's in the room today. Terrific. As is commonly the case, we've got about 23% of the folks from the Bay Area and 25% from the US. Now, sometimes this is a little bit of a function of time, right? It is noon here on Tuesday, April 19th. So that's prime time in North America and South America. And we've got about 4% of the folks from South America. We've got a good contingent from Europe, 20%. And that's great. Sometimes I do evening events and we find there are fewer people in Europe and more folks from Asia tuning in. And also Australia tuning in when we do the evening events. But again, this is a recorded event and I'm going to share it with everybody who registered afterwards. So, so if you're not attending live, still delighted that you're attending. Now, in terms of who's here today, we've got 54% of the audience as new first-time entrepreneurs, another 18% who are serial entrepreneurs, and we got about 15% in early stage companies, and then a blend of folks in academia, some venture investors, whether they're a corporate VC or other VC, some folks in academia, I mentioned academia, no one in government. Sometimes we get some government or media folks. Well, that's terrific. So this presentation is primarily geared towards those who are going through seed financing. So if you're going to do a seed financing and you're going to raise funds, you're going to raise capital, you know, $1 million, $2 million, $3 million, maybe up to $5 million, and you're interested in using convertible securities, this is the topic, and this is the slideshow, and this is the presentation for you. If you are earlier on a company's life cycle, that's great. I think you'll still get a lot of value at this. If you are interested just in the venture ecosystem and how things fit together, I think you'll also get some, value out of this program. And then if you're just an entrepreneur and interested in understanding how things can work and whether or not you're interested in going and pursuing, creating a venture-backed company, I think this will work pretty well for you too. So let's start by just giving some basic general structural considerations about when I talk about a venture-backed company or startups. I'm talking about a specific kind of beast in this situation. I'm talking about companies that intend to be venture-backed, that is, they intend to raise venture capital. The reason why they intend to raise venture capital is that they require, for them to take advantage of a market or product opportunity, they need to grow and scale very rapidly. That's going to happen within a very specific time frame, which we'll talk about in a moment. And as a result, it's a specific animal. It's not just any company that is just starting. This is a very specific animal here. So let me see. Hopefully this will work. That's terrific. Okay, so let's talk about some structural considerations. Now, typically you're going to find that these companies end up as a Delaware sort of C Corp, and I'm sort of trying to highlight this here. I hope that's coming through. First time using this function, so hopefully that works. Now, whether you are starting a venture-backed startup or you are starting some sort of other company, we apply sort of the same framework when we are trying to do our entity choice selection. That is, entity choice selection being, do I choose to have a corporation? Do I choose to have an LLC, a limited liability company, that is? And do I choose to have a limited partnership or just a regular partnership? Or is there some other structure that I want to use? We take a look at this matrix, and in no particular order, we find, depending upon the growth path of the business, it sort of informs what's going to be more important. But we take a look at the tax impact. We take a look at personal liability issues. That is the ability to try and wall off or firewall the owner's personal assets in case of any litigation sort of stemming out of the business of the company, right? That liability shield. We talk about sort of the ownership structure and equity grants. That is, who's going to own this company? How's that going to maybe change over time? We talk about and equity grants. Are you going to need to grant equity incentive compensation to service providers? Those are contractors, employees, consultants, advisors. We think about your capital raising needs and requirements, and kind of what the sets of expectations and requirements that an investor is going to have. We think about management requirements. How is this entity going to be managed? Is it really just going to be a sort of closely held group of folks, maybe 2 or 3 who will be owners? And are they going to be all management, or is there going to be a much broader set of owners by the time this company is mature? In which case, who's going to need to be on management sort of throughout that part of the life, throughout the life of the company. Think about exit strategy. I mean, especially for venture-backed companies, we'll talk about this in a moment, but VCs, venture capitalists, have a set of expectations, and they have a set of investors of their own who they need to meet those investors' expectations. So making sure the time horizons all add up, and there's a sufficient rate of return, is very critical. And we also think about regulatory framework. So some businesses, like let's just take healthcare or finance or law, right? Those businesses are going to be highly regulated, and certain structures and forms are impermissible. So we think about those things. And when we kind of apply that to your sort of typical venture-backed company, we end up with the analysis that it's going to be typically a Delaware C corporation. And let's unpack that a little bit. So, and let's talk about why that is. So typically, a C corp for tax reasons, that's driven by the investor's expectations, which is typically venture capitalists are set up as limited partnerships or other pass-through entities. Pass-through meaning the profits and losses get passed through to the owners of that entity. And if a venture capitalist is going to be, or a venture fund is going to be investing in a portfolio of startups, it would be an accounting nightmare to have a portfolio of 20, 40, however many they have, and passing through all the profits and mostly losses initially to the owners, to their LPs, their limited partners. Those are the people who put capital into the venture fund. So that's why we got a C corp. Why Delaware, you ask? Well, sort of at this point, it's the standard. Most sophisticated companies are established or incorporated in Delaware. Venture-backed companies are on a path to an exit, usually either an IPO exit, we'll talk about that in a second, or an M&A exit. And so typically Delaware is known for having very good corporate law, which means, good liability protection for the directors and officers. And that's important if you are a venture fund, because many times a venture fund, especially if they lead around, will end up with a board seat. So they want to make sure that they're the partner who they have filling the board seat is going to have as generally the maximum amount of liability protection possible. The Delaware Chancery is a sophisticated court that hears a lot of business issues. So this thought process there being, you're going to end up in a venue where you've got a jurist, that is a judge, who understands business issues, and hopefully you've got some case law where the issues have come up before, and so each of the parties' rights is better known, right? That uncertainty creates ability for there to be disputes, and certainty helps get disputes resolved. Delaware Secretary of State's office is also pretty great in being able to process paperwork, which is very important when you get a deal done. And there are a number of other benefits as well. Now, a commonly asked question I get, and it looks like we sort of have one here. Oh, we don't have it here. It's like, well, what if I've set up an LLC? Don't panic. That's beyond the scope of today's conversation, but it's quite possible that you will be able to re-domicile it or convert it to a C corp, a Delaware C corp if necessary. All right, now let's move over to my little graphic. So we've just spoken a little bit about the matrix or the framework that we use, and when we apply that framework to the graphic, we see that there is a common, and not every company is the same, but there is a common life cycle that you'll see with venture-backed companies. Initially, there's going to be that seed capital period where the initial team is put together, the initial prototype is also put together, and it starts to be brought out to market. And that's sort of really where we're focused on today, is raising of that seed capital, from primarily angels, friends and family. Sometimes there are funds that will come down to the seed level. And actually, I was just reading, and it seems like that's a trend that is sort of happening more and more, at least of late, and especially within the last quarter. But that's where we're primarily focused, is this sort of seed capital stage today. But I think it's also really important to know where you're headed with this type of company, right? So this is a company that will raise successive rounds of capital. Now, why successive rounds? Well, it's a way for investors, in part, to manage risk, right? Even if they could put in all of the money that you needed to build the business, if they put all of their money in at once, they won't necessarily know or be able to know that they've made a good bet, right? So what we'll see is, these rounds will get tied to basically business metrics and milestones, right? So, maybe it's, this first round, which is often called a Series A round, although sometimes it's called a Series Seed round. This first round will be tied maybe to getting your product to market and starting to get some traction. Then that money will come in and it will be used to sort of scale up, maybe build a sales team, or maybe build more of a sales team, maybe refine the product, and then, sort of the next round, it will sort of happen on and on until you've gotten the business sort of fully built out. It's relatively mature. You're on the later stage financing, and eventually there'll be an exit. And the sort of goal is, the goal that most people shoot for initially at the outset is to be able to do an IPO. We find, I don't want to get the numbers wrong, but there's probably, in terms of successful exits, there's probably at least 10 successful M&A exits and a whole host of any number of other exits. But 10 very successful exits, IPO exits, compared to an IPO, 10 successful M&A exits as opposed to an IPO exit in any given year. That really does go up and down because there's a phenomenon known as the IPO window, which is, when the public markets are hot, it's a great time to exit into an IPO. When they're starting to pull back, as they have kind of in the last quarter or so, it becomes a bit more difficult to do. So just off the top of my head, there are far more successful M&A exits than IPO exits. So I'm going to take some questions here briefly on this, but I think it's really important because we're framing out what type of company that we're talking about today. Okay, question about what I mean by exits. By exit, I mean sale of the company. So that's, or a sale of a substantially large portion of the company, or sale of an individual owner's portion of the company, right? So if there's an IPO exit, it's not like the whole company gets sold, it's sort of 15, 20%, but it then enables those existing investors to get liquidity. That is, after they wait for the lockup window, they're able to sell their shares of stock. Both investors and other owners, like founders and other employees. But when I'm talking about exit, I'm basically talking about folks being able to turn their ownership stake into cash. Good question. Regarding incorporation state, if I live in California and operate in California, won't I be required to incorporate in California or be fined? So if you're out here in California, that's great. Glad to have you here. What we typically see is that the Delaware corporation will qualify as a foreign corporation doing business in California. So you file basically a notice with the state, you pay a little bit of a fee, you're then, as you would need to do anyway, you'll have to pay taxes in California. But that's how that gets handled. Someone is just sort of asking generally, I'm going to take this and be sort of a more general question, but, choosing between California, Illinois, Texas, Nevada sometimes comes up, versus a Delaware company. What do you choose? Again, almost invariably, like 99.99 these days. It used to be a little bit different 10, 15 years ago, but these days we see companies getting ended up ultimately being Delaware corporations if they're going to have venture-backed investors. Not always, but I mean, it is an overwhelming majority. And so it's my general philosophy, and I think it's shared by a lot of the bar, that you want your technology, you want your products to be interesting and exciting. You don't want your legal books to be interesting and exciting. It just sort of takes away from the investor bandwidth and their desire to be able to invest in you. You want them to be plain vanilla, and where they appropriately match the economics of the deal and the business that you're doing. All right, I will come back to other questions of general applicability. I want to really kind of make sure that we're moving forward with today's event. So let's move into considerations when pitching investors. I'll take the second bullet point first: compliance with the securities laws. So this is an issue that comes up sort of time and time again. Even if you are a very small company, if you are selling shares of stock, or you're selling safes, or you're selling other securities, that is, interests in your company, then you need to pay attention to the securities laws. Now, sort of the consequence of that is typically, unless you're a fraudster, which is not usually the case, it's overwhelmingly unusual for there to be a fraudster, although you certainly hear about some of these folks, and I feel like I may have come across some folks from time to time in my career that might fall into that bucket. But usually the consequence of not paying attention to the securities laws is that you may end up in a situation where you will need to give the money back, rescission, offer a right of rescission. And if you've spent the money on product or other things and you don't have the ability to give it back, and the company is, not more valuable than it was before, it can be a deal killer. It can be a company killer. Now, obviously, there are a whole other parade of horribles which could happen, which is, theoretically, you would need to register your company with the SEC and, or with the state. But usually the solution is you may need to give the money back. And if you don't have that, that's a company killer right there. So you got to retain and work with competent counsel to make sure that you're targeting the correct exemptions, as you're going out and raising capital. And, some of that might also be really developing relationships, with angel investors or other folks in your network, prior to making an ask, so that they can get to know you or know you more and know your company more, and super critical. Now, kind of with that in mind, the other real takeaway here is know your audience and, know what they're interested in. Okay, so there are a whole continuum and spread of different investors out there. We'll talk about some of these briefly. Well, let's just start. We're focused on venture-backed companies. So let's just start with a typical VC fund, right? So a typical VC fund, as I mentioned before, has its own investors, right? Those folks are called limited partners, or LPs for short. They have been, or they expect a return on the money, the capital that they put in. That's maybe seen that the fund will increase 3x over the life of the fund, which might be about 10 years. And each of these is going to be different for different funds. So I'm just trying to give you a general sense for, what's going on there. And the strategy typically employed by venture funds is that they will make quite a number of bets, quite a number of high risk, high return bets. And there are going to be a good number of companies that are unsuccessful. And there will be a number of companies that are moderately successful. But the returns that's going to really kind of make the fund is going to be a couple of, or a handful of really big winners. And that's what's really going to get the return. And when we think about kind of what these big winners may look like, that's typically a company that is doubling or tripling in value every 18 to 24 months. And you could see, if you put in, $1 million at the A round, and at the B round, it's then $2 million. And at the C round, that value, which you put in at the A round, is now worth $4 million, and $8 million at the D. You could see how you could 8x it from there. And then plus, maybe there's an E or D1 or maybe there's that exit, right? And it goes up double or triple from there. And you could see how with the right investment in the right company, you know, a VC could get 24, 50, even 100x the return. Now you can also see how they can lose all of it because it is high risk, but that's typically some of the considerations. And there are different groups, and I don't want to drill in too deeply, but some VCs are generalists, right? So they invest in any number of different verticals, you know, maybe across from health tech to climate tech to finance to SaaS companies, right? Just kind of all across. Or there are other VCs that are sort of specialists, and they will pick a vertical or two, or maybe a partner will pick a vertical or two, and they will focus on that. And there are kind of different plays that they make. Now, there are others involved in the ecosystem, like strategic investments that are made, right? Many times by a corporate VC. And then there are also some other non-traditional players like private equity funds or sovereign investment funds. But thinking about strategics for a minute, you know, they bring something else to the table. They depending on the strategic, they may have other interests, right? They might be focused on trying to develop a market for their products, right? If they sell widgets, they want to have other companies that need widgets in their products, for example. You know, or they might be interested in corporate development, and that is trying to build a talent pipeline or technology pipeline, or they might be trying to maintain their market position and relevance. So those are kind of a number of the preferred and later folks, although they do come down and they do play in the seed space. And then in the seed space, you also will find a lot of angels. So an angel is typically somebody who is wealthy, and they have the ability, and they're an accredited investor. It's something you're going to want to make sure you comply with securities laws. And they've got their own set of motivations. I mean, maybe they're a previously successful entrepreneur. They understand the space. They want to continue to nurture it after they've had their big exit. Or maybe they're interested in an outcome. We see that a lot in the climate space. So getting to know who you're pitching and building a relationship ahead of time is a great strategy and great approach. I'm going to see if we can take, if there are any questions on this. And yeah, so question is, what areas of securities law should we be focused on most when pitching? So securities laws here in the US are regulated both at the state and federal level. Federal, I would say first, I'd switch that around. Federal level and state level. So you need to make sure that you are complying with the securities laws at the federal level, and then each state that you're going to be offering securities in, you need to make sure that you're complying with them. If you're raising outside the US, you need to also make sure that you're in compliance with those or the equivalent laws outside of the US. All right, I'm just looking to see if there are any other. Okay, take a sip and let's move on to the real heart of things. So what are your options? Okay, so we've framed out, you've got yourself, you know, a venture-backed company or a company that desires to be venture-backed. You are looking to raise probably, several $100,000 to $1 million to $2 million, $3 million, maybe more, probably not 20 million. And you want to understand, what your options are. Well, typically we will see that is done by using a convertible security. So either convertible debt, also known as bridge notes, or convertible equity, which is also known as safe instruments for a simple agreement for future equity, which was developed by Y Combinator. And each of the safes and convertible notes are really pretty similar. We'll walk through their key terms in a moment. Another mechanism that you might have if you are, thinking that you're going to be raising them to more commonly 3 or 5 million would be to do sort of a series seed round, or basically a venture round, a price round. That's a different presentation. I hope you'll join me for that when we set that one up. So on a convertible securities side, what we're talking about is we're talking about converting this instrument at some sort of discounted, at a negotiated discount in the event of a future qualified equity financing. Wow, that is like a lot of jargon. So let me just back it up and unpack it for you. So we're talking about taking, let's just say that safe, right? Like if your investor has invested $100,000 in a safe, and at some point in the future, and that point is typically when there's a price round, that is the company sells preferred stock. When that company sells preferred stock, converting that safe into shares of preferred stock. That's basically what we're talking about. Now you may ask, like, and the same goes true for a convertible note. Now you may ask, like, why would you do that? Well, there are kind of two primary reasons for that. One is that using a safe or a convertible note will avoid valuing the company. And I'm going to pause here because when I would do these events in person, I'd often hear sort of like a gasp from a crowd. As founders are oftentimes very focused on valuing their company, right? And they want to see that growth. And so for the lawyer to talk about avoiding the value of the company, it's a little uncomfortable. And the reason for that is that early stage companies, especially seed stage companies, you got to think about it for a second. Seed stage company, what are we talking about? We're talking about a company that's building out its initial team, building out its initial product, and building out its initial go-to-market strategy. So, and trying to get its initial customers. So how do you value that? For later stage companies, once a company is mature, there are like so many different ways to value it, right? There are sort of discounted future cash flow analysis. Lawyers don't do this. There are folks who specialize in it. They're obviously looking at comparable companies, and you can do that even at the earlier stage, but it's very difficult. And the risk is if you try and value the company early, either too high a value will be assigned to it, in which case the investor paid too much for their stake in the company, or the company will value the company too lowly, right? The founders will value the company too lowly, and they will have sold too much of the company. So kicking that can down the road is typically what we see. Now, there's also another sort of incidental benefit that comes up, which is, you have less of an issue in terms of being able to grant either issue restricted stock sort of at a relatively low price, or grant options at a relatively low price if you haven't taken a position or there hasn't been sort of an arm's length negotiated valuation of the company, right? So that's an incidental benefit that many times does accrue. Now, what's another real palpable benefit to using a convertible security? Well, almost always they are far less expensive than a venture round to document, to negotiate and document and get closed. And similarly, they are oftentimes far quicker to be able to pull the trigger on. And speed is crucial, especially early stage companies. The reasons why they're less expensive and quicker is there are generally fewer things to negotiate. And given that the capital that is put into the company is less than what you'd see at a venture round, there's usually less diligence that is done. So it just takes less time. There's less to negotiate. So what is negotiated in a convertible security round? Well, I put asterisks by the terms that are in convertible notes but not safes. So you can see convertible notes have maturity dates. That is dates by which the company needs to pay the money back. Now you may say, oh my goodness, well, what if we can't pay the money back at that point? Great question. Unfortunately, it happens. One thing is try and get ahead of it at the outset, right? So And we'll talk about that in a minute. Try and get ahead of it at the outset. The other is making sure that you've got an amendment provision term sort of over there that you can basically effect an amendment pushing back the maturity date if necessary. And you don't have to go out to each convertible note holder. You can hopefully just get a majority in interest to be able to do that. Interest rates, you'll see that in convertible notes. They have been, I don't know, let's just say 6% plus or minus 2% typically. They could be as low as AFR. As the applied federal rate, but they are typically kind of around 6%. It'll be interesting to see in this sort of higher inflation environment if they tick up. I haven't necessarily seen that at the moment. Amendment terms we talked about, and then there are a number of remaining terms. It's not super common to negotiate those. You work with counselors in the area. There may be some negotiation that's done, but like really the big economic terms are the maturity date, the interest rate, and then the conversion terms. And we're going to unpack the maturity date first, and then we'll move on to those other big ones. And you always, again, want to make sure you've got this ability to amend the convertible notes, and you don't have to go out to each holder. That is if you're company side. And even as an investor, you want to see that mechanism in there so you don't see a future deal held up. So maturity date, typically see kind of 18 to 24 months. Again, as I said, getting ahead of this issue, you should be trying to time this with some cushion, that is some extra time, before you plan to have that price round, that venture round. Out here in California, you should pay attention to the California financing law, which applies to persons engaged in the business of a finance lender or broker. And make sure that you want to make sure that it fits into exemption. Interest rate can be as low as the AFR. Otherwise, there can be imputed interest. Okay, so what is imputed interest? That just means basically the IRS will take the position that you should have been paying interest, and you're going to get taxed on what the interest should have been, that is in you being the company. And it can be as high as 10% in California, although it's I have to take a look at it. It's been a little while since I've come across this issue. That number can float in a higher inflation environment, so it might be higher than this at the moment. Conversion terms. Okay, so this is the next, and this is like probably the one that is like truly negotiated the most. And it's negotiated both at the convertible note, if you're using convertible notes, or if you're using a safe, those conversion terms. So again, we're talking about a mandatory conversion at a discount of the price paid in the next qualified financing. So that means, again, if an event happens, and in this case, we're really focused on if there's a price round raise and it's a sufficiently large price rounds, so there's a number that's chosen, usually let's say 2 million, 3 million. It could be more than that. It could be less than that. But what the investors are going to be focused on here is making sure that the round size is large enough so that so that there's enough incentive that the lead investor and the company aren't playing games, that it sort of accurately reflects the value of the company at that time. So we're talking about converting when there's that preferred financing of a minimum size. And basically, at that point, the safe for the convertible notes would turn into shares of preferred stock. Now, I'll talk about this right now. What is common in our market these days is really seeing what we call a shadow series of convertible note, a shadow series of a shadow series of preferred stock. And that kind of confuses founders sometimes. Basically, it's almost the exact same thing as the preferred stock that the new venture investor is getting, but there's an economic adjustment to the liquidation preference, to dividends, to the anti-dilution provision to reflect the fact that the safe or the convertible note holders got those shares at a discount, right? Because we're talking about a discount here. So I wouldn't focus too heavily on the what a shadow series is. I wouldn't let that kind of weird you out. It's basically the same thing, but just with a tweak to reflect that the safe and convertible note holders got their shares at a discount. Now, there are two kinds of discounts that pop up or that are common. One is just sort of a straight percentage discount. And that is, and we'll walk through some of the numbers a little bit later in the presentation, or at least some model numbers in the presentation. But we sort of typically see 20 or 25%. The lower the discount, the sort of more favorable it is for the company. If you try to cut a discount that is like too great, that could get cut back by later investors. If for no other reason, then it kind of washes out, the existing equity owners, that is the founders and other early stage employees. So that's one mechanism. Continuing on, the other mechanism that you'll hear is a price cap. And that is basically, and we'll walk through a model in a little bit, but at the time of conversion, even though the new money may value the company at $20 million, let's say, if you set the cap at $10 million, the safe or the convertible note will convert as if the company were worth $10 million, not the $20 million. So again, put a pin in that one. We'll come back to it with some numbers so you can actually sort of see how this shakes out. Other things that do pop up, are building in conversion upon a change of control or the sale of a company. Or sometimes another way to address that maturity issue, right, which I talked about earlier. One was to amend it, push back the maturity date. Sometimes investors will negotiate ahead of time. Well, if you hit the maturity date, or the company will elect this, you hit the maturity date, someone's got the option to convert the shares into typically common stock, although sometimes they'll sort of build out preferred stock. The issue is like, what's the preferred stock going to be if you don't have any outstanding preferred stock? And that can lead down a little bit of a rabbit hole. In terms of the structure of actually documenting these things, what you're going to find is that convertible notes generally have one or two documents, and that's in addition to any corporate authorization or side letters that you're doing. But there's like a note purchase agreement and a convertible note, kind of a set of convertible notes. Or sometimes they're all like that. That note purchase agreement and note is it combined just basically into a convertible note, and it's got basically all the terms in there. Safes, just basically one agreement in addition to sort of the corporate authorization that you need to do and any side letters. So let me kind of share with you like a recap as to which you would typically, the analysis that what you do. So you'd be looking again, we're talking about a venture-backed company or a company that desires to be venture-backed, talking about raising, couple $100,000 up to maybe a few million in initial seed financing to build out the initial team and or product, maybe get a little bit of market. Sometimes we do raise a couple of rounds, and sometimes there could actually be companies with 10, 15 or more million in convertible notes or safes outstanding. That's a little bit less common to see, but that could happen. The reason why you choose convertible securities over like these types of convertible securities over preferred stock financing it's just generally less expensive to do, less complicated. You avoid valuing the company, which is pretty hard to do at early stage and get it right or accurate. Helps to maintain a low fair market value for stock and option grants. Downside, especially for convertible notes, is that it is debt. And it does need to get repaid back at that maturity date unless, you've got some mechanism to deal with it and you're able to effect that mechanism. The other issue is, again, convertible notes are debt. And so it's going to get paid, if the company were to get sold or the company were to go under, the convertible notes will get paid back before any equity holders, that is before the founders would get any capital. It's just something to pay attention to. So I'm going to move into foundation basics and talk about valuation and dilution and put some like mock numbers together for you. But before I do, I'm going to see if there are any questions that are sort of general applicability for these terms of safes and convertible notes. A question about what if you keep trying to push back the maturity date and you can't push it back? Is a safe better than a secure than a convertible note? Yeah, I mean, I do think sort of generally speaking, safes are usually a bit more company friendly. I think people, here we are in 2022. I can't believe it, but here we are in 2022. I think investors in the Bay Area are pretty comfortable with safes. And there are, of course, a couple of different kinds of safes, which we won't get into granular detail on here. But, if this were 2013, that's, I think when they first came out, it was a little bit of a harder sell. I think outside the Bay Area, US, folks are fairly comfortable with it, but not in all locations. And then outside the US, yeah, there are some investors who will do safes, but many don't feel comfortable with it. Someone is asking how much money can you raise with a safe? I mean, again, it's going to be investor driven. I've seen companies that have raised sort of 5, 10, heard of companies that raised $15, $20 million on safes. But, no investor needs to invest in your company. So you got to have a compelling reason for why it should be done that way, or they have to feel like they're going to miss, the next greatest thing, and believe that they're going to miss the next greatest thing. You got to have that market power in order to sort of do those larger raises. Otherwise, using a preferred stock, a more traditional preferred financing, it gives the investors a little bit. Well, it gives them more insight in the company in terms of the diligence process. It also gives them more control, or at least negative control rights. So that helps mitigate or helps them feel like they have lessened their potential downside risk. Again, so this was a question about will you be able to receive the presentation afterwards? Yes. So within about a week or so, so long as you have registered, I will email you a copy of the recording afterwards, and it will have my slides in it. Let's see if I can get rid of that. There we go. A question going back to, I mentioned the IPO lockup window. So those are contractual obligations that certain stakeholders have where they can't sell, typically within 180 days of an IPO. And that's to allow the sort of stock price to stabilize. Okay, let's move on. So I feel like this is one really critical area that the founders don't spend enough time thinking about early on. It's the one that they're actually, I think, ironically, most concerned about, dilution. And yet, I find that founders many times don't sort of model out that growth path. Like if I kind of go all the way back to the beginning and like this path, like what does this path look like for your company? At what point, and again, many times there's no break even doesn't happen till later. It doesn't happen there or even later, or, there are some very famous companies that they didn't break even or really start making money, till after an IPO or a SPAC. But, suffice it to say, what does your model look like? When are you going to be raising? And when you do that, you can then build some pro forma cap tables. Now, what does pro forma mean? Well, it's just sort of like a fancy, I believe, Latin word for like sort of like a form or a model. And that's what I'm not going to teach you how to build a pro forma on today's webinar. I have done other presentations where they've done that. You feel free to send me an email and I can send you, well, I don't actually have access to that anymore, but I'm sure we will do another one. But that's kind of how you get ahead of it. It's just basically modeling out now where you think you're going and understanding, yeah, you're right. Like it's a model. Things are going to happen. You're going to have some wins. You'll have some losses. You may not be able to stick to it, but at least you got a roadmap and you know where you're headed. So before we get into that, let's talk just a little bit about some terminology here. So like many things in venture and in this space, there are many names for one thing, and sometimes one thing has many names, and a name can mean many different things. Now, with that in mind, let me go with sort of like what I think is probably the most common way to think about things these days in terms of a couple of definitions. Pre-money valuation. So that is the value of the company before the next round of investment. So immediately before, so let's just think about this for a second. So immediately before preferred stock financing, what does the company look like? Now, many times that's going to be immediately before is going to even include your historic safe and convertible note financings that have been done. And so you may actually have to have a bunch of kind of like mock pre-money valuations until where you're converting one set of safes, you're converting another set of safes, you're converting another set of safes, and then the sort of pre-money for the round is like after that. But let's not get all tied up in that. Let's just say pre-money valuation is the value of the company immediately before the next round of financing, which means post-money valuation is the value of the company after the round comes in. So just as an order of math, if the pre-money valuation on a company is $10 million and then $3 million comes in, the post-money is going to be $13 million. Now, there's another term that gets bandied about quite a lot. And you gotta, in each of the documents that you're negotiating, you got to read the definition because that term can be tweaked and modified, but fully diluted basis. That commonly means all common stock issued and outstanding. So that's common stock that the company issued and that's still out there, hasn't gotten repurchased by the company or canceled for some other reason. Plus all securities that can be converted into common, as if they were converted into common. Plus, and this sometimes is in, sometimes it's out, it's typically in, the shares reserved for equity compensation. So that's your option pool. So with those definitions under our belt, let's just take a pretty simple example, not factoring in the option pool or any other equity because I want to keep it super simple. If the pre-money valuation of a company is $10 million and they're split among 3 equal founders, each of the founders is going to have 3,333,333 shares, or roughly 33% of the company. So we're going to be focused on founder A. Now, let's just say there are no convertible securities that are outstanding, and that company were to just receive a preferred stock financing at $1 a share. Now, how would it get $1 a share valuation? Well, if the investor came in and said there's a $10 million pre-money, you would divide that by the number of shares that are outstanding, and you'll see that it's $1 a share, right? 10 million divided by 10 million is $1. Again, the post-money valuation here would be 13 million. You'll see that founder A still has founder A's 3,333,333 shares, but it's gone down from 33% of the company to roughly 25% of the company. But on the plus side, founder A's got shares that are now worth, at least as a, on the books, paper value of $3,333,333. Awesome. Let's take that example and layer in some convertible securities, but let's keep it simple. Let's just stick with the fact that the new money would be coming in at $1 a share. And let's ignore some of the circular math that would go on in the background. Again, that's a different presentation where we can kind of talk about how that gets handled. But let's just stick with $1 a share. And we're going to ignore having any option plan or anything, even though you would typically have an option plan. If there had been a $450,000 convertible security, let's just call it a SAFE, with a 25% discount, the holder of that security would have received 600,000 shadow shares. Now, I've told you what a shadow share is before. It is basically the exact same thing that the new money is getting, but just with some economic adjustments to reflect the fact that there was a discount when those shares were issued. And how is it that they end up with the 600,000 shadow shares? Well, they put in $450,000, right? And it was $1 a share minus, excuse me, it was, right. And then the discount is 1 minus whatever the discount is times the value of each of the shares that the new money is paying, right? So it's 450,000 divided by 75 cents. That's how you're going to end up with 600,000 shares. Now, if there had been a $450,000 convertible security with a $5 million cap, right? So this is the other major kind of discount that we commonly see. You would see that that holder of the convertible security would have actually gotten 900,000 shares. Again, that holder had $450,000. Here we've got a valuation cap of 5 million divided by the number of shares that are outstanding, that 10 million shares. So you will see here that they would have gotten a greater number of shares if they had the cap. So that's kind of how the interplay is between a discount and a cap. You can have just a discount, you can have a cap, or you can have both. And usually if you've got both, the investor is going to get the greater number of shares, depending upon which one is applied. Now, again, I'm not going to walk through the math on this, but suffice it to say, another sort of pitfall that comes up from time to time is people think, well, as soon as I go over the cap, that is, as soon as my company is worth more than that $5 million, the cap's going to apply. That's actually not right. It's going to be, I think it's, again, I don't want to get in the math on it, but if I recall correctly off the top of my head, it's the cap divided by 1 minus the discount percentage, and that's what it's going to be, right? So you'd have to probably go over like $6 million, let's say, for the cap to apply. If you got like a 20 or 25% discount, 20% discount. Other common pitfalls, we've actually kind of touched on a number of these, and I'm going to open up, we're kind of coming out to the top of the hour. Thanks for hanging in there with me, folks. We're going to take questions in a minute. Non-compliance with securities laws, we've actually kind of talked about this. Again, one of the largest pitfalls or realities is that if you do not comply with securities laws, you may end up needing to give the money back. And if you've spent it, it's impossible to do. It can be a company killer. On a related note, there are people out there who are will offer to find you investors. Unless they're a registered broker dealer, you really, you need to make sure you're working with your counsel to make sure that there is some sort of exemption or ability for that person to raise you capital and get compensated for it. Otherwise, again, it can be a securities law bust. You may end up needing to offer a rescission to your investors. It can be just a nightmare. And there's so many people who are doing that. It's a common issue that founders face. And even though there are a lot of people doing it, doesn't mean that's right. And doesn't mean that you can't be the one that gets sort of popped, right? So another pitfall is just really thinking that there are standard terms. There are never really standard terms. There's a range. Okay, I would think that range kind of for safes is more narrow because that's typically put together by, or the form comes from Y Combinator. For convertible notes, it's a much bigger range. So just saying they're standard, everything can be negotiated. It doesn't mean that any and everything always gets done. There's, again, sort of like a range. Finders is so important that I put it in there again. Side letters. Side letters are agreements outside of the safe or the convertible note that give rights to the investors. There might be the pro rata rights, the ability for the investor to buy, excuse me, more shares, additional shares in the financing, or additional convertible securities if you offer them. It might be information rights for them to be able to learn more about your company. It might be some sort of right or ability to sit on the board, or to have an observer right to sit on, to see what happens at the board meetings, or to obtain information from the board meeting. Hold on one second, I'm sorry. Excuse me. I feel like, especially as sort of these convertible note rounds have gotten larger and larger, and you start to see more sophisticated angels and groups of angels or VCs or other players enter in, side letter requests are becoming more and more prevalent. Depending on the investor, it makes sense to grant them certain rights, but you do need to be very mindful, if you're a company, as to whether or not you're going to grant those rights, because you need to comply with them. And if you give them to that particular investor, you may need to give them to other investors, may ask for them. And so you need to have the right business case. So the other thing is, negotiating side letters just increases complexity and cost. And, one of the primary reasons for doing safes and convertible notes is to kind of keep it simple and relatively inexpensive. Another common issue is just failure to obtain proper corporate authorization, right? So each of these, sales is a sale of securities, and you got to make sure that you're complying with you got to comply with that at the securities law level. You got to comply with it at the corporate law level, and a number of other levels on top of that. So I think that that kind of wraps it up. We're going to take some questions and comments. Thank you so much for attending today. Please, if you've got a question or comment, use the Q&A function. Don't use the chat function. And we've got about a half hour, well, about 25 minutes or so. Okay, another question in terms of getting a recording of the presentation. Yes, so long as you're registered, I will follow up with a recording of the presentation afterwards. Excuse me, afterwards. I've got some sort of more company specific questions. Again, please don't send me any confidential information. If you've got a specific question about your, a situation, and you want to have a non-confidential sort of general information conversation, shoot me an email, jason.gordon@klgates.com. It's, it's listed here. And I do keep office hours, usually Fridays at 2:00 Pacific. If you're outside, significantly outside of my time zone, we can schedule something else. I am traveling this Friday, but I'm trying to answer questions of general applicability today. So. And I'd like to keep today's questions like sort of focused on today's contents, which are seed financing. So, if you got questions about IP rights, or which would include trademarks and patents, or tax, probably not going to get to them today. Is the break-even point the time when the MVP is ready? Well, so I guess when I'm referring to break-even point, and it's different for every company, we're talking about, once the company is sort of out of the red, in the black, in terms of, being able to at least cover its costs. So that may happen when the MVP, it's not going to happen when the MVP is ready, right? You got to get out there, you got to get customers. But it might happen, if you're selling and there's a lot of pull or draw from your customers in terms of like, your MVP is sufficient for them, they like it, they can't get enough of it. What's the best platform to get safes? I'm not sure exactly what that question is. I think, again, Y Combinator, if you're asking about where to find a safe, Y Combinator has them posted. There's also a guide on how to use them. I do still strongly recommend you work with counsel who understand safes, because it's something that you, after you've worked with them a lot, you really understand intimately. If you just see them, you may think you understand it and you actually kind of don't, and you can get yourself in a pickle. The other thing is that there are tweaks that I think each counsel probably makes and that is acceptable to other counsel that, you know, working with counsel will give you the benefit of. I'm sorry, I got a cough, excuse me. Okay, here's a great question from Anonymous, who is probably the person who attends the most events, and certainly the most of my events. There's a question about what's the greatest benefits of issuing a convertible note versus a regular financing round. If I issue debt, don't I avoid losing equity? So I think there's a little bit, let me unpack a little bit of confusion here. If you use a convertible note, it's really a bridge to that investor getting equity. So while it's true, if you issue debt instead of equity, you will not get diluted. That's sort of like regular debt. Like if you got a line of credit from the bank, it's not really the convertible note. It's true, convertible note is truly debt, but it's really designed with the idea that eventually it is going to become equity. Now, there are some, I'm going to pause there. I think that's a great stopping point. I think it addresses your question, and I don't need to go off on a tangent about later stage companies and some non-dilutive financing options for them. Is there a directory of VCs? Wow. There are now so many VC funds and so many potential investors in the space. I don't think there's like a single directory per se, but there certainly are a lot of materials online if you're interested in knowing kind of who's out there in the space. In no particular order, you know, Google searches will return a number of things. There's TechCrunch, Crunchbase, PitchBook. You know, there are a lot of incubators and accelerators that are out there. There are other events like this. I mean, you can really, if you are kind of gearing up to run a process and, you know, interested in going out there and building, you know, substantive relationships with potential investors before you start raising from them. Yes, a lot of information out there. Might take some time to kind of gather it, but it's worth doing. It's worth also learning, you know, not just who's interested and who's been investing in your space, but like, what is it that makes them tick? What are the other investments that they've made? Wouldn't necessarily, you know, go pitch somebody who's invested in a competitor, but maybe something that's complementary might be a good fit or might be a better fit. You know, think about, you know, in one sense, money is fungible. Another sense, investors are not just money. Hopefully, you know, if you're raising from the right investors, they're going to bring, you know, other things to the table. They'll bring other, you know, access to service providers, access to potential customers, you know, and help give you the hallmark of legitimacy, maybe access to other potential investors now or down the road, folks who are in their network. Yes, there's a lot of information out there. Do your research so that when you go out and start to build those relationships, you can hopefully, you know, end up with a successful raise, at the end of the day, right? There are lots of funds and other players who will tell you, we don't do this, this, and this, or in order to be considered by us, you need to do this, this, and this. We want to have this data. So do that so you can get targeted. And, I also sort of think that what is helpful is if you're creating sort of a list of relationships to build, you may want to go, not to your A folks first in terms of trying to build those relationships, but start on the C pluses or B minuses so that you can get some experience, and sort of refine your spiel before you go out there. A question about what to take into consideration when creating a safe note to protect the founders. Again, with safe notes, the primary terms that are negotiated are whether there's a cap, how much the cap is going to be, whether there's a discount, how much the discount's going to be. Oftentimes there's an argument, and I don't mean like an argument like a sort of like fisticuff dispute, but what is negotiated is the cap, and there's, again, within that negotiation, there's sort of an argument that the cap is a proxy for the valuation. There's a philosophy that is out there, certainly more company side friendly, like, well, really the cap is meant to act as like a kicker if it turns out we're able to do a lot more with the money you invest. And that's typically the argument that the company makes. And so you wouldn't want to set the cap at what you think the company is currently worth, because you got the discount, right? So if you got a discounted cap, this is when it comes up. If you just have a cap, maybe it's a little bit of a different negotiation. And if your company, it typically, if you don't have to give a cap, or that cap is set really pretty high, as a founder, that's generally sort of better for you, because sort of less likely you're going to end up getting you're going to be subjecting yourself to more dilution than you would otherwise need to take. Will DAOs replace this process? I don't think so. Question about the chart having positive revenue starting with the rounds of financing. What about cash flow negative businesses? I think I basically kind of answered that before. I mean, that was just sort of one example, or the sort of typical example. It just depends on the business, right? There are some businesses that are not, some venture-backed businesses that are not cash, that are cash flow negative until after IPO. I mean, especially, if you've got some kind of therapeutic or, something that's got to get through the regulatory process, you may not have any revenue before an exit, certainly an M&A exit, right? It might not be until you have, what will be the key off on the exit there might be, hitting a regulatory milestone, and getting some sort of breakthrough there. So again, the examples today are just meant to be sort of illustrative examples, not meant to be the final, your business must fit into the shoebox type thing. Sorry, I'm just kind of looking through some questions. Okay, so there's a question, and it's using some terminology that I'm not super familiar with. It might be coming from outside the US. Again, I'm a US attorney, I'm here in California, but the question really is sort of about, it's from anonymous, so I don't know asked it. But is it fine if you just basically get going and don't incorporate until you need to get funding? I think that's what the gist of the question is. And if that's the question, that would make sense, because I get this question all the time, and am super comfortable answering it. My sort of general rule of thumb on this is, if you are, at least here in the US, and even more specifically here in California, if you are one person and you got an idea on a whiteboard and you're not using other people to do things, not using contractors or other service providers, but you're just sort of developing your idea on your own and just using your own resources at home, right? Like maybe you go out to, I don't know, you're using your own money to buy computers, to then kind of code the thing, and, and to pay for your servers that you need. And, or if you've got some hardware thing, use your own money to buy your own 3D printer, and you're doing some, 3D printing, building a model. You probably don't necessarily really need to, you may not need to incorporate at that point. But as soon as you start getting other people involved, that is, you've got customers, you've got a co-founder, you've got a service provider, you really do need to think about, and you probably do need to incorporate. The goal here in trying to keep those legal books as plain vanilla as possible is being able to track and trace all the intellectual property of the company, making sure it's getting tied into the company, right? And track and trace all the equity of the company, making sure it's getting tied into the company. Those are kind of like the two biggest pieces here. And if you don't have an entity, it's unclear where those rights are residing, right? Who's going to have some sort of ownership interest if you got a co-founder? I mean, you can have a situation where you just start doing work with somebody, you basically got a de facto partnership that's not documented, and potentially unlimited personal liability for each of you. A lot of confusion over who owns the IP, and then if you've gone out and hired other people, is that IP getting tied into the business? So again, the rule, my general rule of thumb, which is going to depend on the situation whether or not it makes sense for you in your situation, is like, if you're just one person doing your own thing, using your own resources, you may be able to wait, but you start bringing in other people and you need to incorporate. Is there a way for non-American citizens to start their company in the US? Yes. So to start a Delaware C Corp, you don't have to be a US citizen, but you do need to think through the immigration and visa piece. I'm not an immigration attorney. Many times we'll find, and I'll have the pleasure and privilege to work with entrepreneurs who are based outside of the US. They've already built a successful company or outside the US, and then they want to come to the US market to either sell or to raise funds or to kind of relocate here. And we work with immigration counsel to kind of make sure that we've got that. And also we work with tax counsel to make sure we got the tax fees fit out. So the quick answer is, like, you don't have to be a US citizen to start a Delaware C Corp, but in order to really kind of build a business, you got to think about, all the things we mentioned before, like, where is the business going to be located? Who are you going to be your business partners? Where is the investment going to be coming from? How are you going to be able to, work here in the US legally? All that stuff needs to get thought through. Here's a good question about what are the factors affecting pre-money valuation. So on early stage companies, again, it's really difficult, and we sort of typically see at most folks kind of using some comparables, but it kind of ultimately is like, what is it that you think your company is going to be worth, given what do you think the growth trajectory is going to be, and can you convince an investor of the same thing? It's not like later stage companies where you can get I mean, you could hire someone to come in and do evaluation, but typically we don't see investors or founders relying on those types of things in the early stage companies. You know, question about selling securities to family members, you know, shares of stock. Yeah, anytime a company sells stock, whether it's to family members or others, you know, you need to be mindful of the securities exemptions, and you need to make sure you need to be mindful of the securities laws, and you need to make sure you're hitting and targeting and getting an exemption. I mean, just because they're a family member, you know, there may be some other buckets of exemptions that they fall into, but, you know, family members can sue you. Family members can sue your company. Sorry, I'm just trying to make sure I'm trying to find some questions of general applicability here. So we've got, and this is maybe a little bit of a later stage question, but I want to take this because it's something that comes up, and it's kind of similar to kind of fundraising. Exit. There's a company that maybe wants to sell. How do you reach it? And they've got a target. They've got a target suitor. So there are a few ways to handle this. Depending on your company, if you feel that, you know, if you've got yourself a valuable company, you know, you could hire an investment banker or potentially a business broker to kind of go out and run a marketing process on your behalf. Lawyers don't do that. They're investment bankers, and depending in certain situations, business brokers are also the people who'd be able to handle that, or M&A advisors, you know, are kind of in between those two things, those two worlds. They work pretty well too. That's maybe one of the ways that you could kind of take yourself one step removed to kind of navigate this issue in terms of, like, you know, demonstrating some interest to sell, but not necessarily giving away that you want to sell, because you don't necessarily want to lose your negotiating power if they kind of know you want to sell, right? That might be the best kind of way to do it. You know, the other thing that we see sometimes is, you know, it kind of depends on where that suitor fits, but oftentimes companies will run like a dual track process, you know, between trying to, you know, they will get to one of those inflection points where they raise more capital and they run a dual track process. They simultaneously evaluate, do we exit now or do we raise? And so sometimes we'll see, you know, companies might approach a potential suitor with the honest and open goal to potentially get an investment from them. And then coming out of that, an acquisition happens. So that's another way off the top of my head, how you might think about it. Again, you know, there is a whole industry, investment bankers, M&A advisors, and even business brokers who kind of cater in here. What kinds of objections do investors have about safes, and what are good counterpoints? I mean, the most common objection I see, especially from investors who are outside the Bay Area, is like, what is this thing? We've not seen it before. You're just telling me you're gonna give me equity in the future at a discount. I don't believe in that. And I will say, I don't necessarily spend a lot of time, you know, advising companies to try and educate those types of investors as to the merits of a safe, because, you know, again, we're trying to keep the process simple. At the end of the day, it's going to be up to the investor if they want to invest. You know, usually if you've already got a bunch of safes out there and there are other investors who are comfortable with it, and or a much larger lead, you just say like, look, the train has left the station. If you want to get in this round, we want to have you in this round. This is the way it's being done. But if it's kind of more like a lead investor or the investors kind of lead, or just a major player in that, if they're not going to be comfortable, a convertible note gets it done too. It's not really that much more expensive, if at all. It does have some pluses and minuses, which is what we talked about, but I don't usually spend a whole lot of time advising my clients to, try and convince, early stage investors to invest in safes if they're not comfortable, if that investor is comfortable investing in convertible notes. Now, sometimes you get in a situation where, I don't know, an investor wants to only put in $100,000 or $200,000, and they will insist it will be for common, or that they will do a preferred round. And then we do spend a bunch of time, seeing if we can get that investor comfortable with a safe or convertible note, because the economics of trying to do a small venture price rounds or even just a common rounds, it just doesn't make sense. And that's where we'll spend more time. There's a question. Are you a lawyer who started your own company? Yes, I have started my own company. I started Putnam Gordon PC a while ago. I built and grew a boutique practice focused on, emerging growth companies and middle market companies. Did that for about 5 or 6 years. Needed a larger platform. I'm now at K&L Gates. So yes, I have lived the entrepreneur's lifestyle and learned a lot. As I like to say, entrepreneurship is really an amalgam of skills, or I view it as an amalgam of skills. And so you improve them by sort of studying and learning, like doing programs like this, being out there and of course doing, and then of course reviewing what you've done. And every entrepreneur I've ever talked to, who's gone through and run a company successfully or unsuccessfully, just smiles and tells me how much they learned. And even when, I do these events in person and, I ask, well, who's had an unsuccessful exit? And they, folks raise their hand. And, I say, well, have you learned a lot? And they just light up and it's like, yes, I know so much more now than I did before then. So glad I can bring my experience to the table as well. All right, let's see. That's kind of beyond the scope of this. All right, I'll take one last question. At what point should a startup begin generating a 409A? So you need to have a 409A before you issue options. That's kind of like the blanket rule. Now, when you issue options, there's a little bit of flexibility. Early on, we can sometimes see restricted stock, that is stock that's subject to vesting, be issued, at really relatively pretty inexpensive prices, 1/10 of a penny, 100th of a penny. And so you can see early service providers, whether they be employees or consultants or contractors, getting stock and equity that way, which also vests over time. With that in mind, I typically see companies that have done some initial financing, maybe a few $100,000. At that point, they're ready to spend the money on getting an equity incentive plan, which is a more elaborate option plan, and a 409A valuation in place. So great question. That closes out our time together. I really want to thank Idea to IPO for organizing today's events. I want to thank my firm, K&L Gates, for helping me put this event together. I want to thank each of the attendees for showing up. Again, if you have registered, I will send you within about a week or so a copy of today's a recording from today, so you'll be able to view everything. If you want to reach out and get in touch with me, jason.gordon@klgates.com. And until then, I will let you get back to building your great company. Take care. Bye-bye.